At first, it doesn't look like a collapse. It looks like discounts. It looks like rising inventory. It looks like, quote, zero, quote, quietly returning to dealership windows after years of absence. And most people see those things and think, finally, the market is normalizing. Finally, I can get a deal again. But that's not what this is. Markets don't snap overnight. They fracture first, quietly, in ways that don't make headlines until the damage is already done. And right now, the US car market is no longer just cooling. It's beginning to break. Sales velocity is slowing. Loan delinquencies are rising. Used values are slipping. Dealer incentives are creeping back in ways we haven't seen in years. These are not random fluctuations. These are stress signals. And today, we're going to break down the data behind them and why this shift may be far bigger than most people realize. To understand where we are now, you have to go back to where this all started. 2020 through 2022 created conditions the auto market had never seen before. Semiconductor shortages crippled production lines. Factory shutdowns cascaded across manufacturers. Supply chains fractured globally, and inventory, the lifeblood of any dealership, collapsed. Days of supply fell below 30 in many markets. In some segments, below 15. Dealers couldn't keep cars on lots long enough to clean them. And when supply collapses, prices do only one thing. They go up. Average transaction prices broke record after record. Used vehicles started appreciating like investment assets. A 3-year-old truck was worth more than it sold for new. Dealers charged markups openly without apology because they didn't need to apologize. Demand overwhelmed supply at every level. But here's what people missed in the middle of that frenzy. This was not organic strength. This was artificial scarcity. And artificial scarcity always corrects. Now we're hitting the wall. And the wall is called affordability. Average new car payments today are at historic highs. Interest rates doubled compared to pre-pandemic levels. Insurance premiums are climbing sharply. Loan terms are stretching to 72, 84, even 96 months just to make monthly numbers manageable. Think about what that means. People are financing cars for 8 years. 8 years on a depreciating asset because the monthly payment on a shorter term is simply out of reach. When payments rise faster than wages, demand doesn't just slow, it breaks. Because affordability isn't emotional, it's mathematical. And the math right now is tightening in every direction simultaneously. And as demand softens, something predictable starts happening on the supply side. Inventory builds. Days of supply are rising across multiple brands. Dealer lots are filling. Aging inventory. Cars sitting unsold for 60, 90, 120 days is increasing. And this matters because of a simple chain reaction. When inventory rises, pricing power declines. When pricing power declines, margins compress. And margin compression is exactly where market breaks begin. You can see it in the data. You can see it in dealer behavior. The signs are there for anyone paying attention. Nowhere is this more visible right now than in the used car market. Used car prices peaked in 2022 at levels that frankly made no fundamental sense. Since then, the correction has been grinding. Auction values trending downward, trade-in offers shrinking, residual value forecasts being quietly revised lower by lenders and leasing companies. And this creates a problem that goes far beyond sticker prices. When used values fall, negative equity increases. Buyers who purchased at peak prices now owe more than their vehicles are worth. When that happens, trade cycles slow. People can't afford to trade out of their current vehicle without absorbing a significant loss. And when trade cycles slow, new car demand gets strangled at the source. The system tightens on itself. But used car softening is just the surface layer. Underneath it, something more serious is developing. Auto loan delinquencies are rising. Subprime exposure is expanding. Extended loan terms that seemed manageable when rates were low are now creating real financial strain for millions of borrowers. And here's the core danger. When asset values fall and loan balances remain high, you get trapped. The vehicle depreciates, the loan doesn't, and the gap between what you owe and what the car is worth widens every month. That's not just a pricing problem, that's credit stress. And credit stress doesn't stay contained. It spreads. If you want a leading indicator of where all this is heading, watch the incentives. Manufacturers do not discount strength. They discount weakness. And right now, rebates are returning. Low APR financing is reappearing. Dealer cash. The behind-the-scenes financial support manufacturers push to move metal is quietly expanding. These aren't marketing promotions. These are distress signals dressed up as deals. Incentives mean excess supply. Excess supply means slowing demand, and slowing demand, left unchecked, accelerates its own decline. Add to this the volatility in the electric vehicle segment, and the picture gets even more complicated. EV pricing has been anything but stable. Tax credit eligibility keeps shifting. Used EV depreciation has shocked buyers who weren't expecting it. Some models losing 40–50% of value in 2 or 3 years. When consumers see that kind of depreciation, they hesitate, and hesitation is contagious. Slower EV turnover means more inventory pressure. More inventory pressure means more pricing pressure. The entire segment is dealing with a confidence problem layered on top of a supply problem, and those two things together are corrosive. Even the luxury market, which often insulates itself from mainstream pressures, is showing early cracks. Luxury vehicles carry the highest monthly payments in the market. Leasing residuals are being recalculated downward. Demand among high-income buyers, while not collapsing, is softening in ways that analysts are watching carefully. Luxury always cracks first. The consumer sensitivity is higher. The margin for error is thinner. And when discretionary spending weakens at the top of the market, it's almost always a signal that broader stress is forming. The dealer community is feeling all of this in real time. Dealers finance their inventory through what's called floorplan loans, essentially credit lines that let them carry vehicles on their lots. Rising interest rates have made those loans more expensive every month. An aging vehicle isn't just a sales problem, it's a daily carrying cost. The longer a car sits, the more it costs the dealer to hold it, which forces discounts that reduce profit, which creates operational strain that ripples through every part of the business. Multiply that across thousands of dealers, and you're looking at systemic pressure building from the ground up. Now, and this is important, this is not 2008. The lending standards today are meaningfully stronger. The financial system isn't carrying the same catastrophic leverage. But the echoes are hard to ignore. Extended loan terms, asset price inflation during an artificial supply shock, consumer leverage stretched thin. History doesn't repeat exactly, but it rhymes. And high prices combined with high rates, rising delinquencies, and softening demand, that is a stress alignment. That is where breaks happen. There's also a psychological dimension to this that gets overlooked. Markets run on confidence as much as fundamentals, and if buyers start to believe that prices will fall, really believe it, not just hope. They wait. Waiting reduces demand velocity. Reduced velocity increases supply. Increased supply reinforces the expectation of lower prices, which causes more people to wait. This is reflexive behavior. It's a loop. And once it gains momentum, it's very difficult to interrupt. The ripple effects of a significant auto market correction wouldn't stay inside the automotive sector. Auto is not an isolated industry. It touches manufacturing jobs, steel and aluminum production, logistics networks, lending institutions, insurance markets. A meaningful weakening in auto demand sends tremors through GDP in ways that most economic models tend to underestimate until it's already happening. We've seen it before. We're watching the early conditions for it now. So where does this go from here? There are three plausible paths. The first is controlled normalization. Prices gradually adjust. Inventory stabilizes at healthier levels. The market finds a new equilibrium without a dramatic break. Painful for sellers, but manageable. The second is a margin compression cycle. Incentive wars escalate. Profitability craters for dealers and manufacturers. Production gets cut, and the industry absorbs a sustained period of reduced margins and volatility. The third, the scenario worth watching carefully, is a broader correction where loan stress accelerates, demand freezes, and we see a sharper, faster unwind. Which path unfolds depends heavily on employment trends, interest rate policy, and how resilient consumer credit turns out to be under sustained pressure. If you're in the market right now, the signals are your leverage. Watch days of supply by brand and segment. Watch incentive growth. It tells you where manufacturers are worried. Watch delinquency rates in auto lending. Watch used value trends in the auction market. These are the early indicators. They move before prices move. They move before the news moves. And in a shifting market, the people who read them earliest position themselves best. Markets rarely shatter instantly. They weaken quietly. Inventory builds quietly. Delinquencies rise quietly. Incentives creep back quietly. Until one day the shift is obvious. And by then, the window has already moved. The car market isn't collapsing today, but it is breaking. And breaks, if ignored, widen. Stay aware. Because in shifting markets, timing isn't just an advantage, it's protection.